I made $34,000 during one of the scariest market crashes in history. And I almost didn't. Because for months before that, I did what most people do. I waited. I told myself, just a little lower, then I'll buy. Does that sound familiar? In this video, we're going to cover 3 things. First, why waiting for a crash is actually more expensive than the crash itself. Second, the mindset shift that separates investors who profit from crashes versus investors who get destroyed by them. And third, the exact strategy I used during the COVID crash that turned my $48,000 into $82,000. And if you make it to the end, I'll even give you a specific investment that makes all of this simple to start. What if the crash itself isn't what destroys your portfolio? Here's something most people don't know about. The stock market has crashed over a dozen times in the last 100 years. 1929, 1987, 2001, 2008, 2020, to name a few. Every time people said the same thing. This time it's different. It's not coming back. And every single time, it came back. If you had invested $10,000 into a simple S&P 500 index fund in 1988 and just left it alone, by 2024, that would be worth over $500,000, despite going through multiple crashes. But here's the scary part. If you try to time the market and miss just the 5 best trading days during that entire period, you'd have 37% less. Miss the best 50 days, you're left with under $40,000. So instead of $500,000, you get $40,000. To make matters worse, those best days almost always happen right after the worst days. So when you're sitting on the sidelines waiting for things to feel safe again, you're probably missing the exact days that make investors rich. This is what I mean when I say the crash isn't the real danger. The real danger is being out of the market when it bounces back. It's like skipping a Black Friday sale and then being genuinely surprised when you're paying 50% more than everybody else. Have you ever watched your portfolio drop and heard that voice in your head screaming at you to do something, anything, to make it stop? That voice, it's not stupidity. It's actually your brain doing exactly what it was built to do, protecting you from threats. The problem is your brain cannot tell the difference between a lion chasing you and your portfolio dropping 20%. It treats both situations the same way. But here's what I've learned. The investors who win during crashes are the ones who recognize that voice and don't listen to it. Warren Buffett said it best. Be fearful when others are greedy and greedy when others are fearful. Most people look at a dropping market and see danger, but smart investors look at it and see a sale. Imagine you've been eyeing a jacket for months. Full price, $200. You don't buy it. Then one day it drops to $120. Do you panic and leave the store? No, you grab 2. That's what a market crash actually is. Everything you wanted to own, just cheaper. The mindset shift is this. Stop seeing crashes as something to survive. Start seeing them as something to take advantage of. Once that clicks, the tactics become simple. Real quick, if you're finding this useful, subscribe so you don't miss the next ones. Have you ever missed an opportunity because you kept waiting for the perfect moment? Like working up the courage to ask someone out, only to watch them walk out of the door before you could even open your mouth. That's exactly what I did with a big chunk of my money during COVID. Back in April 2020, the market was crashing. I had $15,000 sitting in cash ready to deploy, but every single week I told myself the same thing. It's going to drop more, just wait for the bottom. And my mom agreed with me, which should have been my first red flag. Week after week, month after month, I never pulled the trigger. And that cash just sat there, doing nothing, collecting dust like a gym membership in February. By the time I finally felt ready, the market had already recovered. That $15,000 of missed opportunity cost me real money. Money I'll never get back. So if waiting doesn't work, what does? There's a simple but effective strategy that I'm going to reveal to you. It removes the need to constantly make decisions. I stumbled onto it by accident, and even doing it imperfectly, I still walked away with a $34,000 profit. Imagine what I would have made if I had known about this from the start. Here's what I did. With the rest of my money, I just kept buying. $2,000 here, $4,000 there. No perfect timing, no waiting for the bottom, just steadily buying while everyone else was running for the exits. By the time it was all said and done, I had invested around $48,000 across 2020 and into 2022. And when I checked in 2025, that $48,000 had grown to $82,000, a 70% gain. And I was barely paying attention. The difference between the money that grew and the money that didn't, I actually invested one of them. This strategy is called dollar cost averaging, DCA for short. You pick an amount and you invest it regularly, every week, every 2 weeks, every month. That's it. I wasn't even doing it perfectly. I wasn't investing a fixed amount every month. I was just buying whenever I had extra cash after a good paycheck or a slow month. But that instinct of keep buying instead of waiting, that's the whole idea behind DCA. The best part about DCA is that you completely stop asking, is now a good time to invest? Because the answer is built into the strategy. You're always buying up or down, which means you're never waiting. So you're never the person who waited so long that the window just closed. Okay, so now you're thinking, great, I'll do dollar cost averaging, but what am I buying exactly? This is where most beginners spiral. They go down a rabbit hole of stocks, bonds, ETFs, mutual funds, commodities, international markets, and 3 hours later, they've bought literally nothing and their head hurts. So let's keep this real simple. For most beginners, one fund does the job, an S&P 500 index fund. The S&P 500 is just the 500 biggest companies in America, like Apple and Google. When you buy an S&P 500 index fund, you're basically betting on the entire American economy. And remember that $10,000 we talked about earlier? That one that turned into $500,000? That was tracking the S&P 500. The specific fund I point a beginner to is SWPPX. It's simple and cheap to own. You don't need to pick individual stocks. You don't need to understand what a bond yield is. You just buy SWPPX consistently using the DCA strategy we just covered and let time do the heavy lifting. Now, as your portfolio grows and you get more comfortable with investing, you'll eventually want to diversify beyond this. Different asset types, different regions, different strategies, but that's a level 2 conversation and we'll cover those in a different video. For now, the move is simple. Pick an amount, set a schedule, buy SWPPX, and repeat. Small consistent actions done repeatedly build bigger results than any single perfect action ever could. As Aristotle once said, we are what we repeatedly do. Excellence is not an act, but a habit. Now, here's the part where I have to be completely honest with you. Everything I just told you can go completely out the window if you're missing this next part. During COVID, a lot of people weren't just scared of the market dropping. They were forced to sell at the bottom just to pay their bills. All that advice about staying invested and buying the dip, gone. This is easily avoidable with a proper emergency fund. Most people either neglect this or build it the wrong way and don't find out until it's too late. I break down exactly how to build one correctly in our next video here, because when the markets start dropping, you'll want to be the person who's ready to buy, not the person who's forced to sell.